All right, let's talk about Tesla. It's one of the most argued over companies in the world, and for good reason. Everyone calls it a car company, but that label, it just doesn't really capture the whole picture anymore. So today we're going to peel back the layers and try to figure out what's really going on under the hood that's driving this massive, massive valuation.
So let's start with the big question, right? Why is this company still so misunderstood? I mean, you've got one camp saying its valuation is completely insane for a car maker, and then you have another camp that sees a future that goes way, way beyond just building cars. The reason it's so divisive is that people are basically looking at the same company, but they're valuing totally different things.
And this quote, this gets right to the heart of it. This is the core idea for our entire explainer today. You have to stop thinking of Tesla as one thing. Think of it as a stack of different businesses, each with its own story, its own potential. Honestly, it's the only way to make any sense of it all.
So here's how we're going to do it. First, we'll hit the valuation paradox. Then we're going to break down each of those three business layers one by one. After that, we'll look at how you even begin to value this whole bundle, and then we'll wrap up with a core debate and, of course, the big risks. Okay, so part one, the Tesla valuation paradox. Look, if you just pull up a traditional metric like a price-to-earnings ratio and you compare it to Ford or GM, the numbers just look, well, nuts. And that's where so much of the confusion comes from. That simple approach completely misses the forest for the trees. So, what is Tesla today? This one sentence is probably the best description you're going to find. It's a vertically integrated EV, energy, and AI platform. And every part of that sentence matters. Vertically integrated, energy storage, AI-enabled, each one carries a ton of weight in how the company is valued.
And this table right here, this is the mental model you need. Think of it like 3 layers stacked on top of each other. At the bottom, you have the foundation, the core car manufacturing business. Then, you've got the energy platform built on top of that. And at the very peak, you have the most speculative, but maybe the most world-changing part, the AI option. Getting this stack is everything.
Okay, so let's start at the bottom of the stack with layer 1, the auto engine. This is the bedrock, right? This is the business that pays the bills today. It generates pretty much all the current revenue and cash flow, and it's what bankrolled the growth of everything else we're about to talk about.
And this auto business didn't just pop up out of nowhere. It went through these really distinct phases. First, just proving an EV could be cool with the Roadster. Then, the absolutely brutal manufacturing hell phase of just becoming a real car company. After that, it was all about scale. And now, the whole story is shifting to what they call the AI chapter.
Now let's get into the numbers. These are projections for 2025. And yeah, you look at that revenue column, and automotive is still a monster, over $82 billion. By that metric, sure, it's a car company. But, and this is the important part, slide your eyes over to the margin column. That's where a totally different story starts to emerge.
To really understand what's happening, you have to rewind a little bit. Back in 2021, at its peak, Tesla's auto gross margin was an incredible 27%. This was a huge part of the bull case, this idea that they'd cracked the code to making cars more profitably than anyone else. But fast forward to 2025, and that number has been cut down dramatically to just over 15%. And this is a really, really big deal. It tells you that the EV market is way more competitive now. The pricing pressure is real, and that old story about endlessly growing auto margins just isn't what's happening anymore.
And that leads us perfectly into our second layer, the energy platform. Because with the car margins getting squeezed, this part of the business has suddenly become way more important. And it's the part of the story that I think a lot of people are still sleeping on.
So, you have to ask the question, if the main auto business is facing these profitability headwinds, where's the good news coming from? Where is the real margin strength in this company today?
And this slide says it all. I mean, look at this. The energy business in 2025 is projected to have a gross margin of nearly 30%. That is almost double the profitability of the car business. This isn't some little side project anymore. This is a high-margin, fast-growing business in its own right.
So the key takeaway here is simple. Tesla Energy, with its megapacks and Powerwalls, has officially graduated. It's not a hobby. It's a real, legitimate second engine for the company. It's diversifying revenue, sure, but more importantly, it's giving a much-needed boost to the company's overall bottom line.
All right, now we get to the third and, let's be honest, the most controversial layer, the AI option. This is where the valuation leaves planet Earth and goes into a whole different orbit. We're talking about the long-term, high-risk, but potentially high-reward bets.
And this layer isn't just one thing, right? It's a whole portfolio of moonshots. You've got full self-driving subscriptions, you have the grand vision of a robo-taxi network, there's the idea of selling AI compute services, and of course, the Optimus humanoid robot.
And here is the absolute key to the whole thing. This part of Tesla's valuation has almost nothing to do with today's P&L statement. Its value comes entirely from what people believe Tesla might be able to pull off years and years from now. It's pure option value. And it's the reason the bulls and bears can't ever seem to agree.
So, how on earth do you put a number on a company that's got three completely different businesses all bolted together? Well, that brings us to part 5, valuing the 3 layers. You can't just use one simple metric, so you need a more sophisticated way of looking at it.
The right way to do it is with what's called a sum of the parts analysis, or SOTP. And it sounds complicated, but the logic is actually really simple. You just value each business layer on its own, using the right tools for each one, and then you add them all up. You value the cars, you value the energy, and then you try to value the AI options.
And this table gives you a little more detail on how analysts do that. For the stuff that's real today, cars and energy, you use traditional metrics like earnings and cash flow. But for that strategic option layer, all the AI stuff, you have to use a different toolbox. You're using things like probability-weighted scenarios. You're not valuing a certainty, you're valuing a chance.
And this creates this massive gap. The company's reality today is that it makes money building and selling hardware, but the stock price is pricing in a future that looks more like a software company with high-margin, recurring revenue. The entire debate around Tesla is about whether or not it can actually build a bridge from here to there.
Okay, that brings us to our final section, the core debate and the risks. Now that we have the framework, let's get right down to it. What are you actually paying for today, and what are the biggest things that could go wrong?
And look, the risks are very real. First, that auto margin pressure we talked about, it could get worse. Second, and this is the big one, autonomy could take way longer than people think, or it might not even work out at all. Third, the energy business isn't a free lunch. It has its own supply chain and tariff risks. And finally, maybe the biggest risk of all is that the stock already assumes a huge amount of future success is a sure thing.
And this is really the most honest way to sum it all up. If you just strip everything else away and look only at the car business as it stands today, it is very, very difficult to make the math work for the current stock price.
Which leaves us with this final, all-important question. When you buy a share of Tesla, you aren't just paying for today's profits. You are placing a bet on a very specific version of the future. And now, using this 3-layer framework, you can ask yourself, which parts of that future do I actually believe in, and how much am I willing to pay for them?